What's up, y'all? Hello, Travis. Hello, Diego. Thank you for joining. I'm good, Diego. What about you? Starting soon. Don't worry, our time is limited since now my Zoom is not paid. So just opening the presentation right now. Final 15-20 seconds for people to connect, and we begin. Good. Couldn't join last week. Don't worry, the recording is already on YouTube. Like I said, if you ever have any questions, even if you cannot participate, you can still ask them, because I will answer these questions in the end of the presentation. Then I will upload it on YouTube, and basically your question will be answered and you will not miss the topic. So yeah, of course, it's better if you can participate, because then any questions can be answered like literally live. That's it. Spotlight. Okay, so if you're participating live, obviously it's better because your questions can be and will be answered basically immediately, and every question will be like on demand answer and everything like this and that. But still, like I said, if you cannot, no worries, everything will be recorded always and everything will be on YouTube. So I guess that's it. No one is joining yet. It's okay, nice and cozy, just the three of us, my favorite number after 23. Yeah, no one is texting. Okay, I think we can just begin basically. Okay. Share screen, photos, share, full screen. Okay, so today we are talking about the fundamental analysis. Today is the very important beginning topic, because the whole idea of my Patreon, the whole idea of my project is basically to teach people how to invest themselves, besides giving them confidence to basically start investing. So many people are not investing for two reasons. First reason, they are not confident in investing. And once again, I'm trying to solve this problem. Failing, succeeding, it doesn't matter. Like, some people listen, some people don't. Those people who listen, like you all, I'm focusing on you, I'm teaching you, you're doing a good job. You will see in the future, you will be like thankful that you joined this stuff basically. And you'll be like, it is something that you will never regret, long story short, basically. You will see it in the future. And second reason why people do not invest is that just because they don't know how to invest. There is literally hundreds and thousands of companies you can invest in. So like, what would you select? And one of the ways of selecting where to invest is the fundamental analysis, long story short. And me teaching this stuff on Patreon, me being value long-term investor myself, fundamental analysis is what I'm teaching, what I'm using myself. I mean, every single time I am analyzing companies. Okay, and today these are the topics we're gonna go through really quick. First, we'll talk about fundamental analysis. Then we'll talk about technical analysis, because for me, the best thing to do is always to compare something with something. If I give you the definition of fundamental analysis, it is good enough. But if I give you the definition of technical analysis and then I will tell you the difference between these two, this is when I will learn more basically. And this is where you understand the concept. Because if I just explain what is fundamental analysis, this will be just like, I don't know, like class in school. Like, teacher explains something and that's it. Like, okay, end of class, here's your homework, see you next time. But whenever I'm applying this and analyzing this, and I'm comparing this with another stuff, this is where I'm giving you real life examples. This is where I think, at least in my own opinion, will be digested better. The information will be digested better in this way. At least I hope so. So, and then I will talk about really quick about the main ratios and multipliers that I'm using, additional ratios and multipliers that also I'm using. And then, like always, there will be questions asked and answered. And I told this Travis last week, the structure of my presentations right now. So I have slides right now, and in between slides, I will be checking if there are any more people joining or if there are any questions by you. Because if I just keep chat open, if I keep this like Zoom menu open, this is a little bit distracting. But like I said, you can ask questions anytime. I will just not see them whenever I'm talking, so I can completely 100% focus on the topic. But as soon as I'm switching slides, as soon as I'm going to another topic, I will go to the chat, read all the questions, answer them, and then I continue. So long story short, if you have a question, leave it in the chat, or you can even use microphone. If it's like an emergency question, use the microphone and I'll answer them and then we'll proceed. Okay, we begin with obviously the definition of fundamental analysis. And let's see if there are any questions. Okay, yes, 5 chats in the questions. What's up, Diego? Good to see you. Missed last week. Can't wait to send Arthur more money after he makes me a bunch of money. It's all your money. I'm not taking anything. It's all your money. Like, I'm here to teach people. I'm not here to take your money. I'm not here to make your $500. I'm not here to transform them into $5,000. If you can do it by yourself, you keep it all yourself. It's a tip for good work. That's why I have my $8 per month Patreon. So that's my tip, $8 per month. So, okay, what is fundamental analysis? Fundamental analysis is the analysis of a company itself. And this is yet simple, so simple, yet it is very important to understand this. Fundamental analysis is the analysis of the company itself. Its financials, news releases, management team, like everything that's related to the company. And I will talk about technical analysis later, and you will see why it is so important to emphasize that it is an analysis of a company itself. I'm doing this for the 3rd time because it is that simple and because it is that important. One more time, 4th time, fundamental analysis is the analysis of the company itself. And there are 2 ways to do fundamental analysis. First one is qualitative. It's basically from the word quality. And it means that you analyze like management, news releases, like everything like a correspondence that's coming from the company. And once again, from the company. It's not something that like YouTube gurus say, or like in Instagram investing gurus say, like, hey, buy Snowflake, hey, sell Nikola, stuff like this and this and that. These things, they can only start your thinking process, but these things should never be your final decision-making like criteria. Always you need to do your very own research and analysis. And once again, qualitative, it is news releases by the company itself. So you can either go on the company's website or you go to Finance Yahoo, like this kind of stuff, official news from the company, press releases and all this kind of stuff. Management of the company, meaning like if there are like management, like for example, I was doing a video on Nikola and the management of the company has no relevant experience at all. This is the example of qualitative fundamental analysis. I saw the people on LinkedIn, I took screenshots and I saw that those people were never working in their new roles. And this is fundamental analysis basically. But another part of fundamental analysis is quantitative, or from the word quantity, and quantity means numbers. And this is where fundamental analysis of financials comes in handy, comes into perspective. This is basically when you analyze numbers. So once again, fundamental analysis 1 is a fundamental analysis qualitative part. Fundamental analysis quantitative part is the second. It does not need to be in this particular order. It's just like 2 basically parts of fundamental analysis. It is good if you can do one and you can kind of ignore the second one, but obviously the more you do, if you do them both, it's going to be way better. The more analysis, the better. The more analysis you do, the more precise your predictions and assumptions about the stock will be in the future. So obviously, if you just take a look at the management of the company and you see that the management has no relevant experience, yeah, it tells you that the company is not the best company in the world, but still there are so many other fields to take a look at, in order to make your better final decision. So once again, but still, if I absolutely have to select what's better, quantitative numbers fundamental analysis or qualitative news fundamental analysis, I would say that numbers are better because numbers cannot lie. Like, well, I'm assuming that these numbers are correct. And if people who produce these numbers are not lying, that's it. Math cannot lie. That's it. It's just you see the numbers, plain numbers, no emotions, no nothing. You see the numbers. That's it. So you calculate them and you see the condition of the company just how it is. So there is no exaggeration. There is no over promises or over delivering or anything like this. It's just plain numbers. And so once again, the purpose of not once again, but next step, the purpose of fundamental analysis is it allows you to find good and financially healthy companies by doing quantitative and qualitative part. If you analyze the company and you see that it has good cash reserves, it's not that leveraged. For example, debt to equity ratio is not that high. I will talk about these ratios later. If you see that PE ratio is not like crazy triple or quadruple digits numbers, if you see that this number is good, this number is good, this number is good, so this shows you that financially the company is strong, meaning that it can basically survive at least for another like month, year, or decade. Like obviously you need to check the financials as soon as the reports are coming. Like, and usually these reports coming quarterly, which is like every 3 months. And if you see that the company is still doing good, the revenues are increasing slowly, but increasing, like everything is more or less stable and predictable, that's it, like the company is financially good and healthy. Right now, obviously, I'm not going to talk about all these ratios. It's going to be a little bit later. And then in the future Wednesday meetings, we will be focusing on ratios individually in much more details. Right now, I'm just talking about the concept, the basics of fundamental analysis. What is this and why do you need it? And obviously, this fundamental analysis, it is the best strategy for long-term investing because you want to invest in healthy and strong company, correct? You don't want your company to go bankrupt. You don't want your company to file for Chapter 11 bankruptcies or anything like this, basically the same going bankrupt. You don't want your company being heavily leveraged. You don't want your company to be extremely overvalued. You want good company to invest. And for this reason, fundamental analysis gives you this opportunity to invest in a good, kind of stable, strong, and financially healthy company. And like I said, it is very easy to learn the basics. The very basics are extremely easy. You literally just need to know maybe, I don't know, 5 to 10 main ratios. You don't need to calculate them. Yahoo Finance, Wall Street Journal, whatever you're going to use to extract these numbers from. Most of these websites, they calculate these main ratios for you. Like I'm sure if you ever used Yahoo Finance, like you saw P ratio calculated, PSPB ratio, EVR ratio, all of this is already calculated. So it is very easy to learn the basics because you don't need to learn how these numbers are got, basically how these numbers are calculated. You just know how to read these numbers. You basically need to know maybe what's the average number across the industry, what's the good amount, what's the which PE ratio is too high, which PE ratio is too low, which PE ratio is average PE ratio. Basically, you just need to learn how to understand and read those numbers. No math involved in 99% of the times. Okay. Going to technical analysis. Before this, checking really quick if there are any questions. I don't see any questions, so I guess we can continue then. No one is joining as well, so let's continue then. Okay. And once again, if you have any questions, just text. I will answer them in between sections, just like I did right now. So the next stuff, really quick, what is technical analysis? Technical analysis is the analysis of stocks patterns. So remember, I was emphasizing 4 or 5 times that fundamental analysis is the analysis of the company itself, of the company. But technical analysis is the analysis of the stock's behavior. It's the analysis of these charts. It's basically like the stock price was like here this morning, that's here this evening. It goes up like this. You create another graphs like triangles, like all this kind of stuff. I do not use technical analysis because it is purely trading instrument. When you're doing fundamental analysis, it assumes that you invest in a company. You become a part of the company and you want your company to be profitable, so it makes you rich. So you want value of your company to increase so that your investment increases as well proportionally. But whenever you're doing technical analysis, you do not care at all about the company's condition because there are some so-called short selling options like derivatives, all this kind of stuff. Like you do not care about the condition of the company at all. You are not investing, you are trading stocks. So once again, you're not investing in a company, you are trading its stocks. So this is the main difference, and everything you need to know the difference between fundamental and technical analysis. Fundamental equals investing in company. technical means trading stocks. And once again, you do not care. The company can be absolutely devastating, like Nikola or like another companies, Hertz, Kodak, whatever, like all these recent companies. The companies are suffering. The companies might be going bankrupt in the nearest future if they didn't do it yet, if they haven't done it yet. So you assume, let's say so, that the price will go down. Then you do like short selling, which basically means you borrow the stocks from your broker, you sell them, and then you buy them in the future. Hopefully it will be cheaper in the future. So basically, let's say so, right now stock is $100. You borrow one stock from your broker, you sell it, you receive $100, and 2 hours later, the price is like 85. So you buy it back for 85, you give it back to your broker, here you go, $15 is your profit. You got 100 in the beginning, you bought it for 85, $15 is your profit. These things are purely trading. Like, it does not involve you investing in a company. All these things are short term. So you do not care about the company if it's going to exist 30 years from now. All you need is the potential like assumption where the stock price is going to be in the future, in the next minute, in the next hour, maybe the next day. So you do not care about companies at all. All you care is about the behavior of the stock, like how it's going up or down, sideways, whatever, all this kind of stuff. I'm not using this myself, never used it, never teaching, never going to teach it. This is purely trading instrument. And like I said, mostly it's for short-term trades, and it allows you to trade stocks based on market's mood. Like market's mood, it's my own term. I just created it when I was doing this presentation, so it's nothing highly scientific or anything. Like I said, it's market mood. You think that the markets are optimistic, which means that the price is going up, hopefully, you assume this. So you buy stocks now, you sell them later, here you go, profit. If the market is pessimistic, you short sell stocks, make profit, that's it, long story short. And like I said, what I was emphasizing the most, that the company's condition and performance doesn't matter at all. You can trade stocks of good companies. You can trade ETFs, you can trade failing companies, you can trade whatever you want. Trading is extracting profit from the prices going up and down. And for this, medium to high skill is required, because it is like you need to basically construct all these graphs. You need to know the candlestick charts. You need to know how to read patterns. You need to know all these like bullish trends, bearish trends, whatever, like flash stocks, like patterns. No, I don't know any of this. It is purely trading. I'm an investor. I'm not trader. I'm 100% investor, 0% trader. So I don't know this. I don't care about this, but I know the basics, and I know that you do not need to use it if you want to be an investor yourself as well. Next slide, and questions really quick. Okay, I see there are 2 questions in the chat. Okay, is technical analysis and candlesticks related? Yes, exactly. I already answered. Candlesticks, you already know this. I don't know if Diego knows this. Like candlesticks, I know the share screening right now, so I'll just explain it. So candlestick chart is this typical red and green stuff that you see for traders. I'll just really quick Google it and show it to you. Candlestick chart. So long story short, it shows you almost there, like these kind of things. Okay, stop sharing my screen. I cannot do it full screen. Okay, whatever. So these things is the candlestick charts. Or I don't know if you know Diego or not, but these things are called candlestick charts. And we investors, we do not use these things at all. So don't even worry about this. If you're not going to be a trader, don't even worry about this. Like, it's too much information and you don't need this. Okay, so let's go then. Next, fundamental or technical analysis. Basically, I already answered this question. Fundamental analysis is for investors. Check real quick. Okay, yeah. Fundamental analysis is for investors. Fundamental analysis allows you to find a good company to become a part of. It allows you to find a good company to invest in. And you want the company's value to grow in accordance with your, and you want the company's value grow with your investments growing proportionally at the same time. company grows means your stocks are growing as well. Like it is in your best interests to find a good company to invest in. And technical analysis is for traders. You just literally trade stocks, you trade the behavior of the market, you try to extract profit from the market. Optimism or pessimism requires more skill and all this kind of stuff. So for traders, we don't care about this. And fundamental analysis, like I said, is much easier than technical analysis. Like you just need to know how to read the numbers. You do not need to calculate, to build patterns, like to create charts, like this bearish trends, bullish trends. No need to know anything of this. Just need to know how to read the numbers, and that's it. And the best part is that the longer an investor and a trader compete, the more chances that an investor will win. So I'm not sure exactly about the numbers, but in this book, The Intelligent Investor by Benjamin Graham, one of the best books on investing, he was mentioning that there was like, I don't know, 100 participants, let's say, so investors and traders, and like in, I don't know, 85 to 90% of the cases, investors were beating traders long term. So like, what's the purpose of spending so much time trading stocks when you can literally just spend 5 minutes or 2 hours per month investing, and in the end you will beat all these traders who is doing like 24/7 trading. Literally trading is like almost like 6 days per week job. You trade every single day. You can trade on different stock exchanges which use different time zones, obviously. So it's not that it's your 9 to 5. And even if you're not trading, even if your stock exchange is closed right now, it's not that you just sit, rest, watch some Netflix. You are reading the news. You're preparing yourself for the next day. You're creating your watch list. Every single evening you create watch list for the next day. And then you just trade and trade and trade and trade. In the weekends, you also keep reading the news, like read the forums and all this kind of stuff. And like, what's the point of all these things if I'm investing 2 hours per month and 20 years from now, I'm going to beat 90% of these traders. So just waste of time for me. Okay, next slide and questions. Real quick, don't see any questions. I guess then we can continue. Okay, and now I briefly introduce the main ratios and multipliers and areas where I look at when I'm doing my own fundamental analysis. And like I said, I will not go in details about them right now because I will definitely not be able to fit it in these 45 minutes. But these are the ratios that all of them, plus some more, we will take a look at in our next future weekly Wednesday meetings. So right now I'm just introducing them. But for example, next week, we will be talking the whole 45 minutes about, I don't know, P ratio and PB ratio, for example, okay? So right now it's just the introduction, but later we will focus on them and I will explain all you need to know about those ratios. So right now, just get used to these like words, because like if you see these words, like, or I mean, if you're analyzing a company, these are the first words and words combinations, ratios and multipliers that must come into your mind. For example, I see a company and the first thing I'm thinking about is what's its P ratio, for example. If the market is in the distress right now, I'm thinking, okay, what's its debt to equity right now? So these are the first things. These are the main and most important, in my opinion, ratios and multipliers that I personally use. And one quick note about this thing, every single investor has his or her own set of ratios and multipliers. So whatever you see right now on the screen, all these ratios, is just my favorite. But I'm telling you that like 90 out of 100 people will have completely different list. They will have P ratio, PB ratio, I don't know, let's say so debt to equity ratio, but maybe, like I said, 9 out of 10 will not consider, let's say, so return on equity as the main ratio. He will consider this as like secondary ratio. So like I said, every investor is different. And whenever you learn all these ratios and multipliers yourself, you may select your own ratios and multipliers that you think are much more important to you personally. And this is perfectly normal. This is every person's personal preferences. Like we drink, like some people like apple juice, some people like orange juice, some people like, I don't know, tomato juice. So and the same thing as here. I like P ratio, I like PB ratio, I like debt to equity and all the other stuff you see on the screen. Another person might like another stuff. but it's still juicy. Still, the responsibility of a juice is to make you less thirsty, is to drink something, and that's it. It does its job, but whatever flavor it is, it does not matter. And so, okay, so the main ratios and multipliers that I'm using are price to earnings, P ratio, and I would say most of investors will call it as the main ratio. And the idea basically is to see if the company is overvalued or not. If investors on the market think that company is overvalued. So long story short, there are two ways of looking at P ratio. Normal P ratio, average P ratio, let's say, is approximately 15. So approximately 15. And there are two ways of looking at this 15 as a number. So first way of looking at this is that if you invest in a company which has P ratio of 15, you are willing to pay $15 just to get $1 of income, just to get $1 of profit, basically, from this company. So you're willing to pay $15 to get just $1. And the second way of looking at this, if the company you're invested in is having a P ratio of 15, you invest your money in it, and it will take 15 years for your money just to basically return, just to make your money back. Okay, so as you can already see, the higher P ratio, the worse. Like, for example, I don't know right now how much is P ratio of Tesla, but like, let's say so 1,800. So it means that you are willing to give Tesla $1,800 just to get $1 of profit back from it. Worth it? Obviously no. Or you are willing to invest in Tesla and wait for 1,800 years just for your investments to make sense, basically. So it doesn't make sense, obviously. Like, I like Tesla as a company, but I don't like it as an investment, but I guess you already know it. Okay, so next is price to book value, or PB ratio, also another important ratio. So the first one, it shows if the company's P ratio shows if the company is overvalued or undervalued based on the investors' behavior, let's say, okay? Based on the stock market price right now, based on the investors' assumptions, how is the company doing? But PB ratio, it also shows if the company is overvalued or undervalued. But instead of being overvalued or undervalued based on investors' assumptions about the company, it shows if the company is overvalued or undervalued based on its book value. So long story short, if you see that the book PB ratio of the company is more than 1, if more than 1, it's like PB ratio of more than 1 is not good, less than 1 good. What it basically shows, if PB ratio of the company is more than 1, and if the company goes completely bankrupt, its own book value is not enough to cover everything basically invested in it. It's like if the company goes bankrupt, it will be not enough money for everyone. Will be not enough money for investors to receive it back as soon as the company goes bankrupt. So it means that if the PB ratio of the company is more than 1, it means that investors overvalue company in relationship to its book value of the company itself. And this is more mathematical, more strict than P ratio, I think, in my opinion, because like it's just book value. It is whatever it's on the book right now. It is exact value of the company at this very moment based on its balance sheet and all the other books based on all the numbers. And if the PB ratio is less than 1, it means that the company is undervalued based on its book value. It may sound confusing right now, but like I said, right now I'm just trying to introduce these ratios, and later we will go in details about them. P ratio is undervaluation or overvaluation of the company based on investors' assumptions about the price of the company, let's say so. And PB ratio is valuation of the company based on its book value. And you can combine those ratios, you can multiply them between each other, like PE times PB, and you will receive Graham total multiplier. But like I said, this is later about this. I don't even know why I introduced this, but okay, forget about this. We'll talk about this later. And the third ratio, which is also very important in my opinion, is debt to equity ratio. It is literally just shows if the company is leveraged or not. Debt to equity ratio, quick formula, and all these ratios that I told, all these ratios are already calculated for you on Yahoo Finance and most of the other websites. So you don't even need to know how to calculate them. You just need to look at the numbers. Like I said, if PB is more than 1, not good. Less than 1, good. That's it, simple as that. Same with P ratio, more than 15, not good, less than 15, good. Obviously, every sector is different, but this is like average. This is very, very, very general guidance. And debt to equity ratio, it shows if the company is leveraged. And the formula is really quick, is total liabilities divided by total equity. So if you know, the balance sheet has 3 sections. On the left, it's assets, on the right, it's liabilities, and in the bottom right, it's the equity. So you just divide total liabilities divided by total equity. That's it, simple as that. If this ratio is more than 1, for example, I don't know, total liabilities are 100, total equity is like 80. So it's like what, let's make it more simple. Liabilities 4, equity is like 2. So debt to equity will be 2, 4 divided by 2. Or like 6 and 3, 6 divided by 3 is also 2. So these two, what it means? If debt to equity ratio equals 2, it means that the company has $2 of not its own. Okay, so if debt to equity ratio is 2, it means that the company owes, OWES, owes $2 and just owns, OWNS, just $1. So basically it has $2 of its not own money in comparison to $1 of its own money. So it is leveraged. So the higher debt to equity, the worse. So like, I don't know, some companies have debt to equity ratio like, like 17. It means that company just has $1, but it has to pay back $17 back to like banks, to suppliers, to someone else, to its own employees in salaries. So basically for just $1 of its own money, the company owes $17. So as you can see, the higher debt to equity, the worse. And another one is current ratio. And these two, I put them together because they're good to look at if the company is in distress or if the market is as a whole in distress. So current ratio, it shows the ability of the company to cover its current liabilities. So, and the formula really quick, but once again, it is calculated for you. It's current assets divided by current liabilities. And both current assets and current liabilities are the things that must become due in 1 year or less. That's why they're called current, or like current is equal short term. So let's say, so current liabilities are the liabilities that needs to be covered, that needs to be paid within 1 year. And these are usually like salaries, like suppliers, like all this kind of stuff, expenses that needs to be paid in 1 year or less or earlier. And so if you're calculating current ratio, it shows the ability of the company to cover its current liabilities like with its current assets, which basically means if the current ratio is more than 1, it means that there are more current assets, and current assets are like assets that are readily available, especially like cash, accounts receivable, I think, if I'm not mistaken. So these are the money that are mostly readily available. So right now, like you don't need to wait for like 2-3 years to receive the money or assets or anything like this. They have it, you have them right now, or you will have them within a year. And current ratio shows how easily the company can cover its current liabilities within the liabilities is going to happen within 1 year. And if the current ratio is more than 1, it means that the company is pretty confident in its like current, it's in covering its current liabilities, meaning that the company does not have short-term, too much short-term obligations, meaning that the company will most likely feel good within at least 1 year, like very, very general explanation, let's say so. Okay, so the next I'm looking at is the revenues, net income, and EPS percentage changes. And this basically means that whenever you open income statement, this revenues, income or loss, and EPS, all of these are not on income statement, one of the 3 main financial statements of any company. And I'm looking how revenues, income, and EPS is earnings per share, by the way. Everything is calculated for you, no need to calculate. So I look at the percentage change. So I'm taking quarterly, like Yahoo Finance, it shows you by quarter. So like first quarter, second quarter, third quarter, fourth quarter, like quarter by quarter by quarter. And then you see what was the revenue in the first quarter, what was the revenue in the second quarter, what was the revenue in the third quarter. Same thing about income and percent and EPS. And you obviously would like to see those numbers increasing. Right now, because of we all know what's happening in the world, Right now, most companies, they're either not increasing their revenues, income, and EPS, or they're losing this, so percentages are negative, or they're losing them significantly, like restaurants, cruise lines, airline companies. Percentage change of these three parameters is extreme in these sectors because like almost like no people go on the cruises, like so you can guess basically. So, and you need to see a company that at least revenues are increasing stably. Its percentage increase is stable. In my own opinion, revenues are the most important from these three because revenues just shows you if the company makes money. Revenue can be positive. It's always positive or it's zero. But zero, it means that the company didn't make any sale at all in the whole quarter. It's like I never seen basically. So revenues are always positive. Income can be loss. Net income can be loss. So how this happens? Like if the revenue is positive, it just means that the company was selling something, products or services. But if net income is a net loss, it means that the company, even though it made money in revenues, and revenues is on the very top, it just sales. It is, you sold like iPhone, you sold like water bottle for like $100. Your revenue is $100. But from these $100, you subtract salaries, you subtract suppliers prices, you subtract like logistics, you subtract taxes, you subtract this, and that. And in the end, in the very bottom, you come to net income or net loss. So that's why net income, it's called as a bottom line as well, if you heard about this. Bottom line, it means that as soon as you pay everything out of these revenues, whatever is left, it is net income or net loss. And in this reason, revenues can be positive, but net income can actually become net loss because after paying all the suppliers, after paying all the salaries, after paying this, after paying that, you just don't have money left. So you made money by selling, but you didn't keep anything because you just gave money away in order to produce this product or service basically. And same thing with EPS, and I think I need to a little bit accelerate. Already 40 minutes past, incredible. And I have at least one more slide. So an EPS is basically the same. It is earnings per share. You just basically take your earnings and divide them by the amount of share. Like this is like kind of the same as revenues, just gives you a little bit better how the company is performing. And it also takes into consideration amount of shares, obviously. So if you see that the company is doing buybacks, there are less shares. So EPS will be higher, basically. Long story short, like I said, I'll focus it later because I have like 5 minutes maybe left. And another one is profit margin and return on equity. Profit margin, really quick, is the how much money you're saving. It is exactly what I was talking about. This is net income divided by revenues. So long story short, if profit margin is like 20%, it means that for every $1 of revenue, you save 20 cents of net income. And obviously, the higher the profit margin, the better. It means that you are managing your costs very efficiently. And return on equity is, long story short, is the net income divided by total equity. And once again, it shows you how efficient is the management in using equity in producing net income. So for example, you give me $100, you invest in my company $100, and this $100 is equity. And yeah, I am using your $100. I made some profits. I sold water bottles and I made $20. So from your $100 of equity, I made $20 of net income. So my return on equity is 20 divided by 100, 20%. Once again, the higher the return on equity and the higher profit margin, the better. Okay, last slide. I will see any questions. Accelerate a little bit. Yes, there are some 2 questions. Keep your sanity. Trading is investing all your time. Low, exactly. Trading is investing, but the only investment you're doing is your time. And in the end, you are left with less. It's not efficient, basically. Do not trade. That's it. Okay, yeah, your meeting will end in 10 minutes, it says, but I think it was like 5 minutes ago, so acceleration.